Imagine checking your account at the end of each month and seeing $5,000 in dividend payments. Sounds incredible, right? But here's the shocking truth. You don't need to be rich to start building this kind of passive income. In fact, this $25 bill invested weekly could be your ticket to financial freedom. But unlike what you might have heard elsewhere, I'm going to show you the complete truth about dividend investing, both the incredible opportunities and the important realities you need to know. I've learned that turning small investments into substantial passive income isn't just about drip investing or picking random high-yield stocks. It's about building a strategic dividend empire, step by step. In the next 20 minutes, you'll discover the exact math behind turning 25 weekly investments into 5,000 monthly dividends, why most small investors fail at dividend investing, and how to avoid their mistakes. My advanced 5-category dividend portfolio strategy that maximizes both growth and income, the tax secrets that could save you thousands in dividend earnings, and the step-by-step blueprint I use to build sustainable dividend wealth. But before we dive in, let me be crystal clear. This strategy requires patience, discipline, and time. We're not talking about getting rich quick. We're talking about building real, lasting wealth through smart dividend investing. If you're ready to learn the actual strategy that can transform your financial future, hit that like button and let's get started. Let's dive deep into the powerful math behind this dividend growth strategy. I want to cut through the hype and show you the real numbers behind turning that $25 weekly investment into a $5,000 monthly income stream. Let's start by breaking down that $25 weekly contribution. Over a month, that adds up to $100, and annually we're looking at $1,200. On the surface, that may not seem like much, but here's where the real magic happens. Your money grows in 3 powerful ways when you invest in dividend stocks. First, you've got your regular $25 weekly contributions. Second, you've got the share price appreciation of your investments over time. But the most important factor, the one that truly accelerates your wealth, is the power of reinvested dividends. When you reinvest those dividend payments back into buying more shares, the compounding effect is absolutely extraordinary. Let me show you how this plays out using real numbers from today's market. Imagine a quality dividend portfolio with an average yield of 3.5%, historical price appreciation of 8% per year, and dividend growth of 6% annually. Now, watch this carefully. In year 1, your $1,200 investment earns about $42 in dividends. By year 5, your portfolio has grown to $7,200, generating $252 in annual dividends. Fast forward to year 15, and you're looking at a $38,000 portfolio producing $1,330 per year. And in just 25 years, that initial $1,200 has blossomed into a $143,000 powerhouse delivering over $5,000 in annual dividend income. But here's the crucial catch that others won't tell you. These numbers rely on some key assumptions. Consistent market performance, you never missing a weekly contribution, and you reinvesting every single dividend payment. That's a lot of ifs, and I want to make sure you understand what happens in different market scenarios. In the best case, the market outperforms, allowing you to reach your goals even faster. In the average case, you get the projections we just walked through. But in the worst case, if the market underperforms, it's going to take you a bit longer to get to that $5,000 monthly dividend target. The key is understanding these different timelines so you can adjust your expectations accordingly. Now you might be thinking, 25 years seems like a long time. And you're absolutely right. But consider this. The average American spends 30 years paying off a mortgage. The difference is, at the end of that mortgage, you own one asset. With this dividend strategy, you own a portfolio that keeps paying you month after month, year after year. But here's the best part. You can actually accelerate this timeline in a few ways. First, by investing more when possible. Second, by optimizing your stock selection, which we'll cover in just a bit. And third, by taking advantage of market dips to scoop up quality dividend payers at discounted prices. So while 25 years might seem daunting at first, with the right approach, you can shave years off that timeline. Now that we understand the powerful math behind dividend investing, let's dive into what I believe is the most crucial part of your success: the enhanced DRIP strategy. You might have heard of regular dividend reinvestment plans, but what I'm about to share goes far beyond the basics. Think of traditional dividend investing like a garden hose. You're manually watering your financial garden, hoping for growth. But the enhanced DRIP strategy? That's more like installing a sophisticated irrigation system that works automatically, efficiently, and intelligently to grow your wealth. Let me explain exactly how this works. At its core, DRIP means automatically reinvesting your dividends to buy more shares of the same stock. But here's where most investors stop, and that's a massive mistake. My enhanced DRIP strategy takes this foundation and supercharges it with strategic automation, compound acceleration, and intelligent risk management. Let's break this down with a real-world example. Consider Microsoft, a company that perfectly demonstrates the power of enhanced DRIP investing. If you had invested $100 in Microsoft 10 years ago and just collected dividends, you'd have earned about $24 in dividends. With standard DRIP, that number would increase to $31. But with the enhanced DRIP strategy I'm teaching you today, optimizing your timing and reinvestment could have boosted those earnings to $42. That's nearly double the basic approach. But here's something crucial that other videos won't tell you. Not all DRIP investments are created equal. You need to watch out for serious red flags that could derail your progress. Companies with unsustainable payout ratios, suspiciously high yields, or inconsistent dividend histories can destroy your long-term gains. That's why proper setup and monitoring are absolutely critical. Setting up your enhanced DRIP strategy is straightforward, but you need to choose your tools carefully. I've tested dozens of brokers, and for this specific strategy, I've found that Fidelity offers the best overall DRIP features. M1 Finance excels at automation, and Schwab provides superior research tools. The key is finding a platform that offers zero commission on reinvestments and supports fractional shares. These features will save you thousands in the long run. Here's a pro tip that almost nobody talks about. The timing of your weekly $25 investment matters more than you might think. Instead of blindly investing on the same day every week, you can enhance your returns by strategically timing your investments around ex-dividend dates, market volatility, and earnings announcements. This simple adjustment can significantly boost your long-term returns. Think about it this way. Every $25 you invest isn't just buying shares. It's buying you a piece of a company's future profits. When you combine this with automated reinvestment and strategic timing, you're not just building a portfolio. You're creating a money-making machine that grows stronger with each passing month. But remember, a DRIP strategy is only as effective as the stocks you choose to include in your portfolio. Even the most sophisticated reinvestment strategy won't help if you're investing in the wrong companies. That's why I'm going to reveal my carefully developed 5-category system for selecting the perfect dividend stocks for your portfolio. This isn't just about high yields. It's about building a dividend empire that can actually deliver that $5,000 monthly income we talked about. Let's move on to exactly how to choose the right dividend stocks for your enhanced DRIP strategy. Now we're getting to the exciting part. Exactly how to build a dividend portfolio that can actually deliver those $5,000 monthly payments. While other investors chase the highest yields they can find, we're going to take a much smarter approach. I've developed what I call the Pentagon of Dividend Growth, 5 distinct categories of dividend stocks that work together to build sustainable wealth. Let's start with the foundation. Blue chip dividend powerhouses. These are the companies that have been paying dividends not just for years, but for decades. Think about companies like Johnson & Johnson, Procter & Gamble, and Coca-Cola. These aren't the stocks that will make you rich overnight, but they form the bedrock of your portfolio. I recommend allocating about 30% of your weekly $25 investment to these stable giants. They might only yield 2 to 3%, but their reliability is worth its weight in gold. But here's where it gets interesting, and this is something most dividend videos completely miss. The second category in our Pentagon strategy is what I call dividend growth accelerators. These are companies that might not have the highest current yield, but they're increasing their dividends at an exceptional rate. Microsoft, Visa, and Apple fall into this category. Their current yields might only be 1 to 2%, But when they're raising dividends by 10 to 15% every year, the compound effect is extraordinary. This category should make up about 25% of your portfolio. The third category is where we start to see some serious yield: dividend aristocrats. But here's a crucial twist. Instead of just buying any aristocrat, we're going to focus specifically on those with both consistent dividend growth and strong share price appreciation. Companies like Target, McDonald's, and 3M fit this profile perfectly. They offer the perfect balance of current income and future growth potential. I allocate 20% of my portfolio to these reliable performers. Now, let's talk about something most dividend investors get completely wrong: high-yield stocks. Yes, we want them in our portfolio, but with a very specific approach. This fourth category, which I call high-yield heroes, should only make up about 15% of your portfolio. I'm talking about carefully selected REITs, MLPs, and preferred shares that offer yields of 5 to 7%. But, and this is crucial, we only choose those with rock-solid financials and consistent dividend coverage ratios above 1.5. The final piece of our Pentagon strategy, making up the remaining 10%, is what I call tomorrow's dividend leaders. These are companies that are relatively new to paying dividends, but show all the signs of becoming future dividend powerhouses. Think about companies like Broadcom or Texas Instruments a decade ago. The key here is to look for companies with low payout ratios, strong cash flow growth, and clear commitment to dividend growth. But here's the real secret that brings this all together. It's not just about picking stocks from each category. It's about how they interact with each other. When one category is underperforming, another often picks up the slack. This is what I call dividend synergy, and it's absolutely crucial for building that reliable $5,000 monthly income stream. Let me show you exactly how this works in practice. When interest rates rise, our high-yield REITs might struggle, but our dividend growth accelerators often thrive. During economic downturns, our blue-chip foundation keeps paying steady dividends while giving us the opportunity to reinvest at lower prices. This balance is what helps us sleep well at night while our dividend empire grows. There's also a timing element to building this portfolio that most investors miss completely. Instead of buying all positions at once, we strategically build them over time using our weekly $25 contributions. This not only helps us average into positions, but also lets us take advantage of market volatility to grab quality dividend stocks at better prices. But building this portfolio is only half the battle. Next, I'm going to show you exactly how to screen for these stocks using specific criteria that almost guarantees you're choosing the right companies for each category. Plus, I'll reveal the red flags that tell you when to avoid a seemingly attractive dividend stock. Now that you understand our Pentagon of Dividend Growth strategy, let's dive into what I consider the most crucial skill in dividend investing: selecting the right stocks. This isn't about throwing darts at a list of high-yield stocks or blindly buying what's popular on financial media. I'm going to share my battle-tested screening process that separates dividend champions from dividend traps. First, let's talk about something that most dividend investors get completely wrong. They focus solely on yield. Think of yield like the speed limit on a highway. Just because a car can go 150 miles per hour doesn't mean it's safe to drive at that speed. Similarly, just because a stock yields 10% doesn't mean it's a good investment. In fact, unusually high yields are often the first red flag in our screening process. Here's my proven 3-step screening process that I've developed over years of dividend investing. I call it the DGI Trinity: dividend growth, income safety, and business quality. Let me break this down into exactly what you need to look for. Let's start with dividend growth screening. The first numbers I look at are 5-year dividend growth rate. I want to see at least 5% annual growth payout ratio. Should be below 75% for most industries, 50% for growth companies. Dividend history. Minimum 5 years of consistent payments, but preferably 10+ year-over-year earnings growth. Should be positive and stable. But here's the key insight that most investors miss. These numbers tell only half the story. You need to look at the trend. A company with a steady 6% dividend growth rate is often better than one showing erratic growth of 2% one year and 15% the next. Now, for income safety, we dive deeper into the financials. This is where we protect ourselves from dividend cuts. I specifically look for free cash flow coverage ratio above 1.5, as we discussed earlier. Debt to EBITDA ratio below 3. For most industries, interest coverage ratio above 4. Stable or improving profit margins over the past 5 years. Here's a pro tip that served me well. Always check these metrics against industry averages. A utility company will have different acceptable ratios than a technology company. The final piece, business quality, is where most dividend investors completely drop the ball. This is about ensuring the company can sustain and grow its dividend for decades, not just years. I analyze economic moat, competitive advantages, market share trends, revenue diversity, geographic and product line, management's capital allocation history, industry growth prospects. Let me show you a real-world example of how this works. Take Microsoft, a stock that many overlooked as a dividend investment. When we applied this screening process 5 years ago, dividend growth, 10% plus annual growth rate, income safety, massive cash reserves, low debt, business quality, strong moat in cloud computing and software. This analysis would have led you to a stock that's not only grown its dividend, but has also appreciated significantly in value. But equally important is knowing when to stay away. Here are my 3 biggest red flags that signal a potential dividend trap. Dividend yield significantly higher than industry average, often a sign of trouble. Declining cash flow despite stable earnings. Rising debt levels combined with stagnant revenue growth. Here's something crucial that nobody talks about. Timing your analysis. I always check these metrics quarterly, not just at purchase. A company that passes our screens today might fail them tomorrow. This regular monitoring is what keeps your dividend portfolio healthy. Now that you know how to select the right stocks, let's talk about something equally important. How to optimize your tax situation to keep more of those dividend payments in your pocket. Now let's talk about something that could save you thousands of dollars each year. Tax optimization strategies for your dividend portfolio. While most investors focus solely on yields and growth, smart tax management can dramatically impact your actual take-home income. Here's a critical insight that most dividend investors miss completely. Not all dividends are taxed the same way. Qualified dividends are taxed at the lower long-term capital gains rate, potentially saving you 15 to 20% compared to ordinary income tax rates. But here's the catch. To get this favorable treatment, you need to hold your dividend stocks for at least 61 days around the ex-dividend date. Let me break down the 3 most powerful tax optimization strategies I've developed for dividend investors. First, strategic account placement. Think of this like organizing your closet. Everything has its optimal place. Your highest-yielding dividend stocks, especially IRAs and MLPs, should typically go in tax-advantaged accounts like IRAs. Why? Because these investments often generate non-qualified dividends that would be taxed at your regular income rate. By holding them in a tax-advantaged account, you're essentially creating a tax shield around your highest-paying investments. Second, let's talk about tax loss harvesting, but with a dividend twist. When a dividend stock drops significantly in value, you have an opportunity to harvest that loss while maintaining your dividend income. Here's how. Sell the declining stock and immediately buy a similar, but not identical, dividend-paying company. This maintains your dividend stream while creating a tax loss that can offset other gains or up to $3,000 of regular income. Third, and this is something almost nobody talks about, tax-efficient rebalancing. Instead of selling positions to rebalance your portfolio, you can use your regular $25 weekly contributions to gradually rebalance by buying underweight positions. This minimizes taxable events while keeping your portfolio aligned with our Pentagon strategy. But here's a crucial warning. Never let tax considerations override sound investment decisions. I've seen too many investors hold on to deteriorating positions just to avoid taxes, only to lose much more in principal and future dividend payments. Now, let's talk about record keeping. It's not exciting, but it's absolutely essential. You need to track purchase dates for qualifying dividend status, cost basis for each position, reinvested dividend amounts, tax classifications of all distributions. Most brokers provide this information, but I recommend keeping your own records as well. A simple spreadsheet updating your dividend payments and tax classifications monthly can save you hours of headache during tax season. Here's a pro tip that saved my subscribers thousands. If you're approaching retirement, consider building a tax bracket ladder with your dividend portfolio. By strategically planning which accounts to draw from first, you can potentially keep yourself in a lower tax bracket while maximizing your qualified dividend income. But remember, tax laws change, and what works today might not work tomorrow. That's why we're going to talk about practical implementation next, including how to set up your portfolio for maximum tax efficiency from day one. Now that you understand the strategy and tax implications, let's turn all this knowledge into action. I'm going to show you exactly how to set up your dividend empire, step by step, because having a practical roadmap makes all the difference between success and frustration in dividend investing. When it comes to choosing the right broker, I've spent countless hours testing different platforms, and 3 consistently stand out for dividend investors. Fidelity has proven itself as a top choice for long-term dividend investors, offering zero-commission trades, automatic dividend reinvestment, and excellent research tools. What really sets them apart is their fractional share investing starting at just $1 and seamless integration between taxable and retirement accounts. For those who prefer maximum automation, M1 Finance offers an incredible platform with automatic rebalancing and custom portfolio pies that make managing your dividend strategy almost effortless. Schwab rounds out my top 3, particularly impressing with their comprehensive dividend screening tools and exceptional customer service. But here's something crucial that most investors overlook when choosing a broker. They get distracted by flashy features they'll never use, instead of focusing on the essentials. The absolute must-haves for successful dividend investing are straightforward: free dividend reinvestment, fractional share investing, solid research tools for dividend stocks, and an easy-to-use interface for recurring deposits. Everything else is just bells and whistles that might look nice, but won't meaningfully impact your journey to $5,000 monthly dividends. Let's talk about the actual implementation process. I recommend starting with a focused, systematic approach in your first month. Begin by opening your account and setting up those automatic weekly transfers of $25. This automation is absolutely crucial for long-term success. Start with just one blue-chip dividend stock from our foundation category and enable automatic dividend reinvestment. This might seem overly cautious, but remember, we're building a dividend empire here, not a house of cards. Over the next few weeks, you'll gradually expand your portfolio, adding one stock from each of our Pentagon categories. This measured approach allows you to really understand each investment rather than rushing in blindly. During this time, you should also set up a simple tracking system. I've found that a basic spreadsheet works wonders for keeping track of your progress and maintaining clarity about your dividend income. Automation becomes your best friend in this journey, and I can't stress this enough. Set up your weekly $25 deposit for Monday mornings. I've found this timing works best as it often coincides with market dips. Configure your dividend reinvestment to automatically buy more shares of your underweight positions, effectively maintaining your target allocations without constant manual intervention. Just as importantly, set up quarterly reminders for portfolio review and annual alerts for tax optimization. Here's something that hardly anyone talks about but can make a real difference. Keep a small cash position of about 5% for opportunities. Think of this as your opportunity fund. Market dips are like sale events for dividend investors, and having some dry powder ready can significantly boost your long-term returns. I've personally used this strategy countless times to grab quality dividend stocks at bargain prices. When it comes to monitoring your progress, keep it simple but consistent. A quick weekly check of your portfolio takes just 5 minutes, but keeps you connected to your investment journey. Monthly dividend income tracking helps you see your progress toward that $5,000 monthly goal, while quarterly reviews ensure your portfolio stays aligned with your strategy. Annual reviews are perfect for tax optimization and broader strategy adjustments. Remember this crucial point: the best implementation plan is one you'll actually follow. I've seen too many investors fail because they overcomplicated their approach. Start simple. Focus on consistency and add sophistication as you gain confidence. Your dividend empire won't be built in a day, but with these practical steps, you'll be amazed at how quickly it can grow. Now let me show you some real-world examples of how this all comes together in practice, because seeing these principles in action really drives home how powerful this strategy can be. Let me share some real stories that perfectly illustrate both the power and the pitfalls of dividend investing. These aren't just hypothetical scenarios. They're actual experiences that demonstrate what works, what doesn't, and most importantly, what you can learn from others' journeys to dividend success. Let's start with Sarah, a school teacher who began with our $25 weekly strategy 5 years ago. Like many of you, she was skeptical at first, wondering if such a small amount could really make a difference. She focused primarily on our Pentagon Strategy's foundation category, building positions in companies like Johnson & Johnson, Procter & Gamble, and Microsoft. What made Sarah's story particularly successful was her consistency. She never missed a weekly contribution, even during the market downturn of 2020. When others were panic selling, she stayed the course and even increased her weekly contributions to $35 by cutting back on unnecessary expenses. Today, her portfolio generates $650 in quarterly dividends, and more importantly, she's seen her dividend income grow by an average of 8% each year. But not every story is a straight path to success. Take Robert's experience, a cautionary tale that perfectly illustrates what not to do. Robert started with the right intentions but made the classic mistake of chasing yields. He loaded up on high-yield stocks paying 8 to 10% dividends, ignoring our balanced Pentagon approach. For a few months, everything looked great. His monthly dividend income was higher than investors who'd been at it for years. Then came the dividend cuts. 2 of his largest holdings slashed their payments, and his monthly income dropped by 60% virtually overnight. The lesson: short-term yield isn't worth sacrificing long-term dividend stability and growth. The 2020 market crash provides another valuable case study. Those who followed our Pentagon strategy saw something remarkable. While their stock prices temporarily declined, 92% of their dividend payments remained stable or even increased. This real-world stress test proved the resilience of quality dividend stocks. One of our community members, Michael, even used this period to accelerate his plan, investing his entire stimulus check into dividend aristocrats that were trading at discount prices. Today, that single decision generates an extra $175 in annual dividend income. Let me share a particularly interesting case from last year's rising interest rate environment. Lisa, a retiree who built her portfolio using our strategy, found that her diversified approach paid off in unexpected ways. While her REITs initially struggled with higher rates, her banking and insurance holdings actually increased their dividends, more than offsetting any temporary setbacks. This real-world example perfectly demonstrates why diversification across our 5 Pentagon categories is so crucial. But perhaps the most inspiring story is Tom's decade-long journey. Starting with just $25 weekly contributions in 2013, he stayed consistent with our strategy through 3 market corrections, 2 job changes, and countless market predictions of doom and gloom. He never tried to time the market or make dramatic changes to his plan. Instead, he focused on gradually building positions in quality dividend-paying companies, reinvesting every payment and staying patient through market volatility. Today, his portfolio generates over $3,200 in quarterly dividends, not quite at our $5,000 monthly goal yet, but steadily moving toward it. These real-world experiences teach us several crucial lessons. First, consistency matters more than timing. Second, quality dividend stocks prove their worth during market stress. And third, the path to dividend success isn't always smooth, but staying committed to a proven strategy while avoiding the temptation of unsustainable yields ultimately leads to success. As we wrap up these case studies and move toward our conclusion, remember that each of these investors started exactly where you are now, with the decision to take that first step toward building their dividend empire. Let me be completely honest with you. Building a $5,000 monthly dividend income stream isn't a get-rich-quick scheme. As we've seen throughout this guide, it takes consistency, patience, and smart strategy. But here's what I know for certain. Starting with just $25 a week, you can build a dividend empire that generates lasting growing income for years to come. Let's quickly recap the essential elements of your dividend journey. We began by understanding the real math behind dividend growth, showing how small, consistent investments can compound into significant income. Our enhanced DRIP strategy provided the foundation for automated wealth building, while the Pentagon of Dividend Growth strategy showed you exactly how to structure your portfolio for both income and growth. We covered crucial stock selection criteria, tax optimization techniques that could save you thousands, and practical implementation steps to get you started right away. But knowledge without action is worthless, so here are your immediate next steps to take today. Not tomorrow, not next week, but today. First, choose your broker. Whether it's Fidelity, M1 Finance, or Schwab, pick one and open your account. Don't get caught in analysis paralysis. Remember, all three options we discussed will serve you well. Second, set up your automatic weekly transfer of $25, even if you haven't decided on your first stock purchase yet. Getting this automation in place is crucial for long-term success. Third, pick your first investment from our Blue Chip Foundation category. Remember, start with quality and build from there. Remember those case studies we just discussed? Sarah, Michael, and Tom were once sitting exactly where you are now, watching a video about dividend investing. The only difference between them and those still dreaming about financial freedom is that they took action. They started their journey with that first $25 investment, stuck to their strategy through market ups and downs, and kept their focus on long-term dividend growth rather than short-term yields. Think about where you want to be in 5, 10, or 20 years. Imagine checking your account and seeing those dividend payments rolling in. $1,000, $3,000, and eventually $5,000 every month. That future is possible, but it starts with the decisions you make today. Will you be like Sarah, who never missed a weekly contribution and now enjoys growing dividend income? Or will you be like countless others who put off starting, always waiting for the perfect time that never comes? The choice is yours, but I sincerely hope you'll take that first step today. Join our community of dividend investors. Hit that subscribe button and start your journey toward dividend success. Remember, every great dividend portfolio started with a single investment. Make today the day you begin building your dividend empire. Thank you for investing your time with me today. If you found value in this guide, please give it a thumbs up and share it with someone who could benefit from starting their own dividend journey. And don't forget to join our dividend investing community by subscribing. We're all in this together, supporting each other on the path to financial freedom through dividend investing. Now it's your turn. Take action today, and let's build that dividend empire together. Always consider your own financial situation and consult with a financial advisor if you're unsure about any investment decision. The information provided here is for educational purposes only and is not financial advice.